Trade tensions bring a heat wave of volatility, yet dairy markets remain steady, and the bumper crop in the Corn Belt sets a hopeful stage for some good buys on corn and soybean meal. This and more today as we catch up with Curtis Bosma from High Ground Dairy on the Uplevel Dairy Podcast. Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current opinions as of July 16th at 12 p.m. Central Standard Time and only represent the views of the speaker and not those of High Ground Trading unless otherwise expressly noted.
This episode is brought to you by High Ground Dairy. High Ground Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain.
Curtis, well, welcome back for our July market update. But before we get into the markets, can you provide a quick personal update, Curtis, because you've had some excitement within your own family in the last few weeks?
Yeah, it's been a little busy time here on the home front. My wife gave birth to our second daughter, so been a little short on sleep over the past week or so, but excited that everyone's healthy and everybody's doing great. So,
well, congratulations on your little baby girl, and glad that you could step away for a few minutes to jump in and let us know what's been going on in the markets in the last month. So, Curtis, take it away.
Yeah, so from a market standpoint, looking at cheese and butter and all these markets, we've really been going through the summer doldrums where hasn't seen a lot of action one way or the other. As we recall, cheese prices from over the last month have come down a little bit. We're down about 10% in the key cheese markets such as block cheddar here in the US. That's been weighing a little bit on class 3 prices. We've seen class 3 kind of start to trickle lower here over the last handful of weeks. I think looking at the broader scope, things that we've been talking about throughout the entire year, we know that there has been this increase in cheese processing capacity out there that's been weighing on markets by providing a lot more available product to be sold. We've also seen a bit of an increase in milk supply here in the U.S. The key regions where processing capacity has been growing, we have seen expansion on the farm side in lockstep with that. So it's been weighing on prices to a certain extent, but we do have a little bit of buoyancy to the cheese markets overall just because of how we are positioned here globally. The U.S. cheese prices still continue to be at a price level against the rest of the world to where, barring any trade wars or any other issues, we are continuing to see pretty good demand from the export market, and that has kept things moving. So I think overall from the cheese market and U.S. milk supply standpoint, we're really keeping a close eye here over the summer months on what's happening with not only these trade wars, because there's been within the last handful of weeks even more developments of now we're making sure dairy's on the list with Canada, which could have some longer term benefits to the US potentially, but I would say in the near term, any sort of trade progress that happens between the US and Canada is going to have not too much of an impact on markets. The big one to continue to watch is Mexico. That's been a top headline for a lot of commodities, especially considering that they are the largest customer when it comes to exports out of the US. They're buying approximately 50% of US milk powders. And that's been a little bit of a contentious thing. Depending on what hour you're refreshing your Twitter feed, you're going to see a lot of different ways that this is going to play out for the U.S. economy.
Curtis, what are we seeing in the butter market in the last month?
I mean, key domestic fundamentals are relatively unchanged. We're still in the same spot where we've had strong domestic production, but we've also had solid export demand, again, similar to cheese, where the butter prices have been somewhat competitive to the rest of the world, and domestic demand has kept things going there as well. So that market has been kind of range bound, to say the least, but because we have the robust production, at least at this point in time, it's a little bit more unlikely that we're going to see a crazy run to the upside. I know in the last 2-3 years, we've seen $3 to $3.50 on the board. I think we could definitely see something where butter prices here in the U.S. get up to $2.70, maybe $2.80 if holiday purchasing is really aggressive. But for the most part, it seems like those markets are going to have a lot less volatility to them. One thing I would point out, we've been talking about the influence that this export demand has had on both cheese and butter, is that there are a lot more things that can impact that demand when we're talking about exports. And this goes not only just for cheese and butter or dairy commodities, this is all commodities really, because when exports are a primary source of incremental demand that's moving product out of the country and lightening our balance sheet and bringing prices up, it's great, but it tends to be a demand that can be a bit inconsistent just because of the amount of factors that can influence it. We're monitoring closely all these things regarding trade wars, but then we're also taking a look at currency valuations of where the US dollar stacks up against the importing countries and how likely is it that they're going to be moving those products to those countries. Just because there's a price differential doesn't necessarily mean that there's an immense demand that's going to keep things going. So I would say longer term perspective, it's exciting that we're opening a lot of these export opportunities. I tip my hat to all the trade organizations that have been instrumental in making sure these things are staying in motion. But it does get us into a point where, like many other commodities historically, as we become more and more reliant on export demand to keep our balance sheet in check, we're going to be susceptible to far more market volatility in the long run. So just something to always be mindful of. The good times are still here for the most part, but there could be some challenges ahead.
And so let's pivot then to the non-fat dry milk and whey outlook. What are you seeing in those areas of the markets, Curtis?
Yeah, so on the milk powder side of things, it's been a little bit supportive here lately. We've seen stocks kind of dropping in the US. We've been able to shift a lot of the product out of that stuff. We've seen over the last couple of years, not a new trend by any means, but manufacturers have shifted away from making commodity grade non-fat dry milk and skim milk powder into trying to find some more value add channels for that product. Again, we're monitoring closely the situation with Mexico because they are a buyer of roughly half of all of that product. If they are going to impose any sort of tariff on US dairy, we're going to definitely see some downside in that market. When we're looking at milk powders, it's also important to think about where production's at globally, because when we're competing for business with both non-fat dry milk and dry whey, those two commodities really trade on the global stage. And right now we're seeing a lot of milk production growth out of regions like South America as well as New Zealand. Farm prices for farmers in New Zealand have been actually quite spectacular here as of late. So with that, there's been investments in expansion and growing how they can on an island, but it's been still a positive outlook for them.
So Curtis, as we shift over to looking at the grain market, lots of growth going on here, as I'm guessing most farmers across the country can see when they look out their window into the fields. But give us an update of what you see going on in the markets related to corn, soybeans, and more.
Yeah, so a lot of downward pressure on the corn market. I know we got the nearby months of old crop down below $4 per bushel here briefly. It's kind of come back up here a little bit in recent days. We're getting to some of these crazy low levels. And like you said, when we're talking to farmers, particularly across the Midwest, everyone's saying the crop's looking quite spectacular. I've had people sending me pictures of their kids standing in cornfields for the 4th of July, which I think is a very Midwest tradition, right? You have to do that. People send me those pictures. And then as of here recently, about a week or two later, taking a look at those same fields and those same spots, and the corn has shot up because of just the perfect conditions that we're in. So as of this week on Monday with the crop progress report, USDA has rated the U.S. corn crop at a 74% good to excellent. And then just given how many acres were planted early on this season because of the known sort of tensions on the trade side, and with the soybean complex having a less positive outlook than corn, chances are this is going to be a pretty sizable corn crop coming out this year. So I think that's been weighing on the market. I think it's been priced in to this point now. I think some of this recent upward momentum we're seeing is just on the back of exports, because exports for U.S. corn have been relatively strong. I think the big thing there for dairy farmers taking a look at this corn market is a lot of people have been evaluating, because prices are at a favorable level now with where spot contracts are at or where nearby pricing is, compared to the stuff that's further out. A lot of people are saying, hey, I really like the price we're getting now. Can I build some length and get these sort of prices out into the end of this year and even into the first parts of next year? One of the interesting things about commodity markets, and for people that have heard me speak at various events, one of the things I tend to say all the time is futures are not a forecast. Futures have a fundamental function of how they work. So when prices for a commodity get low, we tend to see that carry in the forward curve, or how much the price in those futures is relative to the spot market gets steeper and steeper. So right now, if we're having a spot market that's near $4, when you're looking to build that length out into the future, you're looking at prices that are closer to $4.40, $4.50, and people get a lot less excited about paying up for the curve. With that, there's a lot of strategies that we could utilize in the futures and options space to build some flexible coverage, to not lock in a fixed price against that heavy carry. That's been something that we've been pretty active in here over the last couple of weeks, especially with given where people are positioned. But yeah, I think that's something that with this big crop and with the expectations, we want to see people staying proactive and taking advantage of it, because the market has priced in the expectation of a big crop, but we have not harvested that crop yet. So there are still things that can happen between now and harvest that may change opinions and market sentiment about where things should be.
And I'd like to dig into that strategy side a little bit here, Curtis. But before we do that, can you also update us on the other parts of our grain market that you usually hone in on, taking a look at soybean meal?
Yeah, so on the protein side of things, soybean meal, we keep smashing records with how much we're crushing here domestically. It's been another one of those trends with the demand for biofuels and things here. We've been making massive investments in that. And as a result, soybean meal prices have been dragging on some historic lows, and similar crop conditions for the soybean side of things. A good to excellent rating for that is still above 70% for the U.S. soybean crop this year. So that's going to continue to be a bit of a struggle here. We're seeing prices below $300 a ton all the way out through May of 2026 right now. So a lot of good buys there on the protein side of things. I think both corn and soybean meal to a certain extent have some potential downside here in the months to come. But again, the market is pricing in all of these factors, and we want to make sure that producers, when we're thinking about this strategically, that we're not just going to assume that everything's going to continue to go lower forever. We need to make sure we position ourselves against any surprises to the upside.
And on that note, talk a little bit more about that positioning and the strategic approach to taking advantage of the markets and where they're at and some of those good buys, but also making sure that you're protecting yourself for something to go wrong. Because if we know anything about this industry of dairy and egg commodities, it's that just as soon as you think you know what's going on, things can change. So what are some of those strategic approaches that you are looking at and guiding producers to take?
Yeah, it's funny how I feel like a lot of this is in this world of finance and risk management. There's a lot of math involved, but it's also a lot of psychology of being able to do things and understand when it's time to take action on specific things. But the specific nuts and bolts of what can be done to build that flexible upside coverage. So as a dairy, when we do this with our advisory clients looking at feed usages and such, is looking through your ingredient list, there's a number of commodities that are being fed out to cattle that are correlated to a futures contract. In most cases, that's either going to be corn or soybean meal, as to why we always talk about those two primary key components. And with that, we're looking at what's happening with those prices, because the futures prices are going to actually change what those cash prices that are going to be quoted out are, where those levels are at. So whenever a dairy farmer is quoted for, hey, I can buy Q4 corn delivered to my dairy at X price, the price you're getting quoted for that delivery includes a futures price of what the market is pricing that corn at on the Chicago Board of Trade. It includes a basis of what it costs to move that corn from its original location. Corn futures are physically deliverable, so the physical delivery location is Chicago. So if out here in California, that basis can be $2, $2.20 per bushel to move corn around. And then Midwest, obviously, that's a lower number you're dealing with. But then there's also the margin that the mills that are making those, they are not in the business of losing money when they deliver feed to dairy. So there is a mathematical equation there. So when we're looking at building sort of this flexible coverage as a producer, when you're quoted a longer term contract from a feed supplier, there's really only one thing you could do is you could either buy it or not buy it. And so it's a little bit more of a binary situation where, hey, we're just going to lock in this fixed price or we're not going to take that price. And we're going to see what the future may hold for us. But as we know, because the futures market is a component of that pricing calculation, if the futures market does move, then that's going to impact that price. So there's other positions that we could take in the futures market directly to be able to protect ourselves. So like a simple thing would be buying a call option. So if you were to buy a call option, it effectively sets sort of like a price ceiling for your corn futures or your corn purchases out into the future. So those are a lot of the more simplistic strategies that we're employing for people. I mean, there's lots of different option things we can get into, and we could really get into the weeds in that maybe on a future podcast. But the nuts and bolts of the story here is you have options beyond just what you're being quoted for corn being delivered. And so if you're looking to build length and looking to take a more proactive approach here, this is the time to be considering those sorts of things, because we're in the driver's seat. We have a position right now that's presenting a great opportunity going out into 2026 where dairy producers can put themselves in a position to secure some longer term profitability here.
Curtis, when we look at all of the tools available for risk management, you've just outlined some things that people can look at adding to their arsenal. But something that you and I have talked about recently here on the podcast is the addition of LRP as an option. And so just a quick catch up that's now been available to dairy producers for the last few weeks. What are you seeing as far as the interest and adaptation of the Livestock Risk Protection programs?
Yeah, so the new updates and the ability to cover the unborn calves, I think it's a great addition to the toolkit for dairy producers. It's already been very popular among our clients of people looking into these things and being able to utilize them to secure some very good values out into the future. We didn't cover cattle markets in our rundown before, but the feeder cattle market also touched a record high as of last Friday, the 11th of July. We kind of come down a little bit. We're actually climbing back towards that high again today here. But yeah, at these super lofty levels, I mean, you're hearing people that are selling day-old Holstein Angus crosses for now $1,400. And it wasn't that long ago we thought, oh, it's crazy, they'll never get to $1,000 a head. And now we're at 14 plus. So with that becoming a significant revenue stream, the ability to protect that and build some length and have that sort of downside protection in place, it's been huge to be able to do that. And it fits really well into like the three problems that we're helping producers solve for with the milk, the feed, and then the herd and beef solutions as well. So I think right now when looking at milk prices out into 2026, when you see class 3 milk at $17 or $18, you don't get super excited, because there's been periods of history where, yeah, we've seen $20, $24 milk, things that are in those lofty levels. But I think it's important to sharpen that pencil and understand, looking at it holistically, of how much milk revenue is potentially out there with the current price levels. Again, throwing in what we can protect on the beef side as well. And then also building that flexibility and having those strategies around the feed market. And then working all those things together to a complete solution is what we're always driving for, because we're not in the business necessarily of only taking action when milk prices are at record highs. We're in the business of securing good margins for producers so that they can keep those legacies going as long as possible.
And Curtis, on that note, we will have a link in our show notes for additional resources for dairy producers that want to learn more about the work you do through High Ground Dairy, as well as have access to some of those monthly market updates as well. And anything else that you'd like to add on this July report?
I think from dairy producers looking at markets right now, we're in a pretty good spot. There's some good numbers to work with out into the future. I would really just encourage people to continue to sharpen that pencil, look at building more systems around getting yourself financially organized to understand where these prices are at, what you can protect, because I think we're always telling people when we're making decisions, if we're doing it from a basis of price where the only thing that we're looking at is what's the price of these things, well, then it does cause a lot more hesitation. But if we change that mindset and we change it to, hey, we're going to make decisions from a basis of margin, of how much money can we make, what is the spread between the cost of feed and the revenue being generated from both milk and beef sales coming off the dairy. Well, when all those numbers add up and there's a solid margin there, that's when it's time to take action.
Excellent. Well, thanks for those final thoughts today, Curtis, and we'll see you again next month.
Yep, thank you.